Hello traders, Gary Wagner with the gold forecast here. Monday morning in Honolulu, Hawaii, 7:30. It is the 25th day of October and this is the daily report. Gold has backed off the highs but is trading about $10 higher, currently $13.38 to $13.39. In today's report, we'll discuss the actual maturity of a pattern. That's the Three River Morning Star, coming off of that long-legged doji that we began to talk about on Friday, all here on today's daily report. Traders, I really believe this is just the opportunity that we've been waiting for. As you know, when we tracked this potential top here, this is a couple of weeks ago, we did exit our positions, and we exited our positions right around 1365, so right in this area, which wasn't too bad of a call looking at it now. The market, of course, did come down. As we watched the market come down, we were looking for some key signs. The most important of those signs, as I talked about last week, is the fact that when I look at some of these bottoms, you always get this consolidating candle come at the bottom of these corrective waves, right in here, here, and here. This is what we've been talking about. The reason that I go over it is I can't stress the point enough that what I have seen and what I have basically delineated from the information available to me is that the doji, which is that consolidating candle, is very, very accurate in calling these bottoms of the market. It seems as though when the market's going down, that doji is an absolutely significant candle. On the other hand, when the market's going up, you get clusters of them all through the market, and they're no more than breathing room, consolidation areas, and they are not the typical top indicators that I've seen in other markets. Why I find that so unusual is that it's very rare for a single candlestick type to react so differently in an uptrend as compared to a downtrend. And gold is really one of the only markets that I have ever seen in which it reacts so differently. So in fact, we got what we were looking for. And in fact, that seems to be a pretty valid signal, because what I was talking about, and I did issue a buy signal yesterday, traders who are in should be in at 1337. It did have a high of about $17 higher. It did back off the highs, but as you can see, we now have that Three River Morning Star that I talked about. It's very interesting when I look for a pattern to develop and we actually see the pattern develop exactly as we anticipated. That doesn't happen all the time. Traders, of course, we want to maintain our long position and we want to keep our stops right here at 1310, protective stops at 1310. Now, aggressive traders, you should have cost averaged and you had one position up at 1345. You'll have another one at 1337 or two at 1337. So that will put your effective entry price down a little bit. And that's why I said aggressive traders have to take an aggressive stance. If we attempt to get into the market earlier as an aggressive trader, by the way, I am a conservative trader, but for those of my subscribers that are aggressive, you have to maintain that aggressive stance all the way through. Now, of course, with an aggressive stance, you're substantially increasing the risk, and you're also substantially increasing the reward potential. So there's that push-pull effect. Traders, as we do this report, it seems as though gold is attempting another rally here now, trading up around 1340. I took a look this morning at our weekly chart. Let me put it up for us. And here's what I'm finding that's interesting. This is the weekly chart of spot gold, Forex gold. And as I have said before, what I look for in the weekly chart, of course, you're not getting signals you can trade off of, but it's a way to kind of step back to look at the patterns that develop. And you get these very, very nice patterns, of course, at the tops and the bottoms of these markets. Now, what I found interesting, of course, is we've had this succession of straight red candles as we had this incredible bull run, and then we kind of ran into a brick wall here when we did get that retracement. This is that wave 4 right in here. It only took a week and gave us an engulfing bearish. When I looked back in terms of a historical perspective, and this is what I'm finding interesting, wherever we saw that engulfing bearish, except for one occasion, the market itself did tend to sell off. And here's what I mean. When we look at this, this is an engulfing bearish, although they're very small candles, and then you see the market trade lower. In the same, if you look back here, you have an engulfing bearish, and then of course the market trades lower. However, in this case, you had an engulfing bearish, and the following week, this is Monday, so it's a very, very short week in terms of our candlesticks, you have what appears to be tentatively this consolidation and the market moving back up. There is one other time when we look historically when we've seen that, and that is right here. In other words, we had this very, very strong engulfing bearish, but it was followed the following week with a long red candle. The market then trailed up before it sold off. In other words, it hit a contract high, went down, retraced, made another contract high, and then had its final descent down before this push up. In terms of historical data, I always want to look at how the market has reacted previously. Does that mean that that's going to happen again? Well, absolutely not. But as a technician, what we have is historical data to work with, and we can ascertain from that historical data probabilities and likelihoods that history will in fact repeat itself. So I thought it would be interesting for us to point out the fact that we did not get confirmation, and without that confirmation, it does appear even on the long-term charts that this market is headed back higher. Traders, as you know, when I'm doing market analysis, I like to take a look mostly at the daily, then I will kind of stretch it out and look at the weekly, and then I'll compress it, and I tend to look at the 60-minute gold chart. And what that does is it gives me microcosm and macrocosm, let's say, view of what we have just witnessed. Now, the first thing is you see this beautiful ascension that we have takes us up to about 1320. Then we get this big spike here that takes us above that 1350 point. We get our retracement, and then we get our new historical contract and records high as it goes here at 1388. We get our first pullback. We get a little bit of covering. And then, of course, this is that large dip that we just experienced, taking us down to, on an intraday basis, as I said, around 1314 right in here. And what you can see in the 60-minute chart is just how well of a base it's forming. And it does appear at this point, at least, that it is tracking back up to go to the contract highs. Traders, in terms of straight projections, what I like to do is take a look. Of course, this is our wave A, and all I'm going to do is simply make a copy of that, and I'm going to then paste so that we have another line here. And of course, we want to verify that that is a auto scale, which it is. So it's going to allow us to do a little bit of upper level forecasting in terms of our target. Now, this is under the assumption, of course, that wave 5 will equal wave 1. And as you can see, this puts my new target right around 1420. Now, this is simply based on the assumption that typically in a bull market run, your first wave is your benchmark wave. You use that to calculate waves 3 and then waves 5. And the basic rule of thumb is that wave 3 should be about 1.61 times that of wave 1, and wave 5 should be about equal to wave 1. Assuming that this holds true in this case, our target right now, as I said, is going to be around 1420. So we've entered our long. We have put a stop in the market. Aggressive traders have entered along and dollar cost average. Now, if the market does want to follow through, we should see some nice profits here. The other thing that we do want to be aware of is that this is, according to Elliott Wave Theory, Wave 5, which means that at the end of Wave 5, we should see some correction. Now, here's what I find time-wise very, very interesting. Look at historical data. The market has sold off in the past right around Christmas, right towards the end of the year. When we reached our contract high at 12/21, December 2009, we had just a terribly hard sell-off following that. Will history repeat itself? Again, we do not know, but I can tell you this, that since we are looking for this point here as the conclusion of our impulse phase, it wouldn't surprise me to then go into some sort of a corrective period. Now, I don't like to forecast out too much in time, but if we look at it this way, we've got our wave 3, wave 4, and then we get our wave 5. Our correction off of wave 5 could be fairly sizable right in here and bring the market back down. We'll have to see what the future brings. As long as we're all together for this adventure and we can profit from it, I think we're going to see a most interesting ride in the weeks and months to come. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow. Bye-bye.
When I look out my window, many sights to see.